Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 12th and 26th. Check out these two exciting two-part events, which we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials. Visit etfmarketinsights.com for more information. And remember to subscribe to our YouTube channel for fresh weekly content. Hit the alert button so you never miss a post. Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today I'm joined by my colleague, Andrew Vachon from the product team at BMO ETFs, and Tony Dong, our special guest. Tony writes for many major publications out there in Canada and in the US. Tony's also a very strong proponent of passive investing strategies, so it's great to have him on. His work has been featured in a lot of major publications out there. USA Today, TheStreet, Motley Fool here in Canada. And today we're going to dig into specifically asset allocation ETFs, which is a topic on the mind of many people, which we'll get into the growth of this product range as we get into it today, but really looking forward to that. As a reminder, today we are not providing any investment advice or recommendations. Today's episode is all about providing education around investing and around using ETFs for Canadian do-it-yourself investors. And before we get into it, just a quick reminder to check out our YouTube channel. If you have not already, please remember to subscribe and ring that bell. That way you'll be notified each and every Friday as we go live with new shows. So welcome, Tony and Andrew. Really looking forward to our chat today on asset allocation ETFs, and I'm glad to have you both with me. Let's jump right into it. Andrew, starting with you, asset allocation ETFs I mentioned are growing in popularity. Walk us through the numbers in terms of growth to get us started, please.
Yeah, thanks, Erin, again for having me on. I appreciate that. So these asset allocation ETFs have certainly grown in popularity. As you can see here, they now represent about 3.5% of the total assets within Canada. That brings us to 12.8 billion. And just to put it into perspective how quickly that's grown since March of 2020, we were sitting at somewhere around 4.7 billion, and now we're at 12.8 billion. And it's just getting started. A lot of people aren't aware of all the benefits that asset allocation ETFs do provide, and we think that it's only going to go upwards from here.
That's great, and I think the media has been covering it like crazy, and oftentimes we hear about it being a product for people just getting into investing, but I think there's a whole other range of uses for the product too, which we'll get into a little bit more today. But Tony, thanks again for joining us. You've written at length about these asset allocation ETFs, so I thought it would be nice to have another voice other than BMO to walk us through sort of what they are and what are the key benefits of them.
Absolutely. So I like to look at these funds as a one-ticket investment solution for Canadians who are kind of tired of the need to tinker with a portfolio, manage many individual stocks or ETFs. These funds use an ETF of ETF structures in that they wrap a basket of underlying ETFs in them, whether equities, bonds, and sometimes you may even find structured products like, say, covered call funds under to provide income. But the point is that they take the emotion out of investing. They're set according to various predetermined asset allocations suitable for investors with different risk tolerances and time horizons. And as I said earlier, it's managed on your behalf by professionals. All the work of rebalancing, picking which sectors, markets, or geographies to invest in, all of these decisions that investors struggle with are now out of your hands. And while some of us may say, oh, but I like to tinker, the fact is investing should be boring. If you want excitement, you go to the casino, but it's like a bar of soap. The more you handle it, the smaller it gets. And with asset allocation ETFs, you barely have to touch that bar of soap.
Tony, I know you're a writer, but I think you have a voice for radio and you should be doing more podcasts.
People keep telling me to do podcasts, and I figured this is my in to get started. You guys know what you're doing.
That's great overview. Thank you. So what's sort of the difference as you see it, or the benefit of going with an asset allocation ETF rather than just building the portfolio yourself?
There's a study out there that shows that the average investor's money-weighted rate of return consistently lags the time-weighted rate of return of their fund. And that's because investors frequently make numerous cognitive biases with their decisions. They buy high, they sell low, they chase hot asset classes, they constantly try to pick winners. Even if I had a portfolio of bonds, Canadian stocks, and global equities, I'm still tempted to shift those. Maybe if US stocks are on a tear, I'll let that run a bit. Maybe if Canadian stocks are doing well because of inflation and an oil-heavy economy, I might overweight that. But these decisions aren't necessarily made in the long term. Picking the right assets ex ante before the event happens is exceedingly difficult. And there's a saying that all models and all systems are wrong, but some are more useful than others. And the rational, rules-based approach of the asset allocation ETF is the best approach under these circumstances.
Yeah, I think also a lot of people underestimate sort of the cost of managing a portfolio themselves, not just, that opportunity cost of potentially your emotions getting in the way, but the trading in and out, the rebalancing.
Absolutely.
Of portfolios.
There's a bid-ask spread for all ETFs, and you notice that for some that hold less liquid assets, say corporate bonds, emerging market equities, small cap equities, these ETFs, even though the creation redemption structure gives them liquidity, there is still more of a spread. So if you're constantly buying and rebalancing yourself, you're losing a couple cents, and over time that can add up. Jack Bogle, the founder and late chairman of Vanguard, called this the tyranny of compounding costs. You want to make sure that your returns compound, not your costs.
Very good point, for sure. All right, and Andrew, let's talk a bit more about how sticking with that asset allocation that you've chosen over the long term can really benefit investors.
Definitely. Well, first and foremost, an investor should determine what their investment profile is to determine what the risk profile is. Can they stomach volatility in markets with the understanding that they'll benefit over time by staying invested? How long will they be invested for? Are they in the decumulation phase, accumulation phase of their life? Are they saving up for a house, getting married, saving for children's education? How much fixed income should they have in the portfolio? You get the idea. So your asset allocation mix is the primary driver to volatility, the returns in your portfolio. How volatile your portfolio is and how different your portfolio performs on a month-to-month basis is largely driven by the asset allocation decision. This famous study done in 1986 by Brinson, Hood, and Biebauer is referenced over and over again. And it shows that the asset allocation explains over 90% of the variation in the portfolio's quarterly returns. It's really one of the most important investment decisions an advisor can make when deciding how to build their portfolio based on their financial goals. ETFs can be efficient asset allocation tools to target specific markets or asset classes for exposure in a cost-effective manner. Furthermore, by having access to different asset classes in your portfolio, you really smooth out the ride and you make your investment journey not be so bumpy. It's proven based on studies that having holdings that aren't perfectly correlated can add to your risk-adjusted returns in your portfolio.
That's great. And then, Tony, what about rebalancing? We talked about how that's sort of emotionally hard, but can you get into more on how this can add value to the portfolio over time?
Right. Like Andrew noted, rebalancing when you have uncorrelated assets that are volatile on their own, but all have positive expected returns. When you rebalance them, you give yourself the chance to actually sell high and buy low. And the other part of rebalancing is that I look at it as the guardrails on a portfolio. If your equities go on a run and your asset allocation is 60-40, and after a big bull market, they go to 80-20, by bringing that down to 60-40, according to your preset guidelines, your guardrails, you're actually limiting your portfolio's volatility and ensuring better risk-adjusted returns. If you let that run, like many people do, right? Many people get emotional, they chase performance. It sets you up for potentially much higher downside risk later down the line. The ultimate part about rebalancing is really there's conflicting evidence on whether you should do it annually. Some people do it quarterly, some people do it monthly. People with very volatile assets may even do it daily. But the important thing is to have a plan and stick to it. And because that's hard for many people to do, myself included, having that out of your hands with an ETF is good. I've seen way too many posts on Reddit of people saying, oh, I'll hold a equity ETF and a bond ETF. I'll use the bond ETF to buy the dips. Well, that's just another form of market timing. When you use an all-in-one asset allocation ETF that has the bond ETF part incorporated, that's being managed professionally on your behalf. And you can guarantee that it's being done in a systematic manner, which is all that matters here.
That's right. Yeah. And this is a study of an old study. So that's why we have for illustrative purposes only. I wish they'd renew it, but I think the story would probably tell much the same, where you can see the lighter blue portfolio that's getting that regular rebalancing is going to add quite a bit more in performance over the long run as well. So really powerful picture there to look at as well. Andrew, we talk about diversification benefits and how it's the only free lunch in investing. Walk us through how that applies to the asset allocation ETFs.
Sure. Asset allocation ETFs diversify by investing in assets across geographies, asset classes, and currencies to reduce the risk within the portfolio and enhance returns over the long term. By spreading your investment dollars across a range of assets, you can smooth out the bumps of individual investments that go up and down and potentially earn higher returns without taking on any additional risks. John Bogle famously said, don't look for the needle in the haystack, just buy the haystack. And his point he was trying to make was that it's impossible to know which stocks will outperform in the future. So rather than picking individual winners, investors are better off just diversifying across a range of stocks. This way they can capture the market's return. So stock picking and really trying to time the market can be very difficult, and many investors enjoy the benefits of diversifying that asset allocation ETFs do provide. And as mentioned on a previous Market Insights call, there are 4 major geographics that you'd want to look at when investing and making a portfolio on your own. Canada, US, developed countries such as EFI in the international space, and emerging markets such as China, India, and Taiwan. And on the equity side of those asset allocation ETFs, you can access all 4 of these regions. And on the fixed income side, even you'll get access to Canada and US, broken down between government, corporate bonds, and all along the yield curve, short, mid, and long. So you can see here for ZEQT, here you get access instantaneously to 3,000 different companies in one solution. Since ETFs are very transparent investment vehicles, you can see the breakdown of this particular ETF, and you can even view the ETFs inside of that portfolio if you visit our respective website, bmoetfs.com, and you could have a look at it there. With ZEQT, you could easily be your one-stop shop. They're very flexible ETFs as well, where you can make small purchases, consistent purchases over a length of time, and they're very low cost and potentially commission free, depending on your trading platform you're using. And having them auto rebalance is at no additional cost is super convenient.
And Tony, how are you seeing investors using these portfolios?
Well, there's 2 ways. The first one I mentioned is the set it and forget it, right? Like Andrew mentioned, you gain access to US, developed, emerging markets, and with a Canadian home country bias. That is thousands of equities in your portfolio that you buy with a single ticker. It's highly capital efficient. I think a share of ZQT trades at what, like $30 right now, somewhere around that range. Boom. Imagine trying to buy 9,000 stocks with $30. Like fractional shares wouldn't even cut at that point. So that's the first option. Set it and forget it. You're globally diversified. You don't have to worry about one geography doing well, one sector doing well, small caps, large caps, industries. You're not making any bets anymore. You're making a broadly diversified bet that the world economy continues on its trajectory over the last 200 years, which is, I think, as safe as it gets. It's going to be volatile because it's equities, but the risk of ruin, my ulcer index, is not going through the roof anymore. The second way is what I call the core satellite approach. ZEQT and ZGRO and all your other ETFs, they provide broad access to bonds of all maturities, credit qualities, and equities from all geographies. But what they lack is an allocation to alternatives, additional assets that have different risk return profiles and respond well to different economic conditions. A prime example would be commodities, right? Or real assets. So you have real estate investment trusts. They're not represented too much in these ETFs. You have gold, silver, you can have agricultural commodities. There's a lot of ETFs on the Canadian market that provide access to these. On their own, they tend to be very volatile investments. They're not that great if you hold a lot of them, but they are uncorrelated to stocks and bonds. So when you have a great foundation set with ZEQT or ZGRO, you can layer on these additional assets, say 5% to gold, 10% to broad commodities, 5% to real estate, 5% to infrastructure. And BMO has a bunch of great specialty industry index ETFs for those. Then you can achieve an even higher degree of diversification and reduce your downside risk even more. And if you want to get really wild with it, you can add in some really exotic asset classes like Bitcoin through some Bitcoin ETFs. Personally, I'm not in favor of that approach, but it just shows you the versatility and the good foundation you can establish. So at the very least, if those side bets go wrong, you have a good core to fall back on, and returns are not going to differ too markedly from, well, the market.
Yeah, that makes a lot of sense. I mean, some people don't follow the markets. They might just buy this. Some people have those passion asset classes, whether it's, you know, clean energy or things they think are going to move the market going forward. So it's a great way to do it in that core explore strategy for sure. All right, lots to choose from in the asset allocation ETF space. So Tony, take it away. What are our options out there for products?
Well, BMO offers a range of asset allocation ETFs with preset mixtures of stocks and bonds. So what I'm looking at here right now is the conservative and the balanced versions, 40-60 equities and bonds and 60-40 equities and bonds respectively. These are very classic asset allocations, and historically they have provided a very good risk return profile. Now, there are exceptions, and the main one are years where interest rates and inflation simultaneously rises, like in 2022. That hurts most diversified portfolios because bonds are falling in tandem. But if we break down the construction of ZBAL, you're seeing some very good things here. You have an overweight to Canadian equities using the TSX Cap Composite, which is our benchmark index for the Canadian market. The US market, your main core holding for that is the S&P 500, which itself is a fantastic index, but you're also including mid-cap and small-cap exposure with additional BMO ETFs. For international and emerging, you are using the benchmark indexes, which provide low tracking error and low costs. And what I like about some of the BMO international ETFs is that they hold the stocks directly. There are some providers that hold a US ETF that hold US stocks. So you're getting two layers of foreign withholding tax there, and that can really impact your returns. And BMO doesn't do that, which I like. On the bond side, I see Canadian aggregate bonds. So these are government and investment grade corporate bonds of all maturities. It averages out to a duration of around 7 years, which is kind of a sweet spot for most investors, right? It's like Goldilocks and the Three Bears, not too hot, not too cold. But what I also see is an overweight to Canadian government bonds, which are very high credit quality. And when a crash hits, these tend to fall a lot less than aggregate corporate bonds. And also US corporate bonds, which add an additional source of risk and return. You're getting a different, what we call credit risk premium from this different geography. And I think that's always important because many investors will just hold Canadian bonds, and you're just subject to interest rate risks and idiosyncratic geographical risks from the Canadian market. So I think you should diversify bonds too. That's what I like here.
Great points. And then as we move up the risk chain,
ZGRO. ZGRO is, if you're an aggressive young investor like me, an 80-20 equity balance tends to be a fairly popular choice for those with my degree of risk tolerance and time horizon. Personally, I'm not a big fan of 100% equity ETFs because my view is that many of the investors who are in their mid-20s have not invested through market conditions like 2008, where equities suffered a 50% haircut. And a lot of people think, oh, 50%, not a big deal. Well, imagine if you had a portfolio of $100,000, you wake up the next day and it's 50. That feeling is horrible. As a person who used to invest in cryptocurrencies, I have been through that, and I can tell you it is not a fun experience. So it's better to be conservative with your asset allocation and stay the course than overextend and panic sell, because once you panic sell, it's all over. A lot of people are going to cash right now, and it might not be the best choice, but it's human psychology, right?
That's a good point. Yeah. So there's really sort of something for everybody for any investment time horizon, risk profile. So that's sort of the beauty of these. What about these last couple here, Tony?
I am a big fan of ZMI. A lot of investors look for income solutions, but they don't diversify with it. So you'll see people go all in on Canadian dividend stocks, go all in on real estate investment trusts, corporate bonds, preferred shares, covered call ETFs that only track a specific sector or market. ZMI is great in that you're getting US dividends, Canadian and international dividends. You're getting global dividends, and I think there's a covered call, there's a derivative overlay on that increases it. But you're also getting credit risk. You're also getting returns or credit risk with the Canadian and US investment grade corporate bonds. And you're also getting some preferred shares. So you're layering on different sources of risk and return, all with an income focus. And I think as a whole, it's very balanced and it pays out distributions monthly. What's not to love about that? Your competitors here are, I think, FIE from iShares, which is the financial monthly income ETF. It holds preferred shares, corporate bonds, and common stock, but only from the financial sector, which, as we saw with Silicon Valley Bank in the last month, is a big concentration risk problem. And of course, for ESG investors out there who want to make sure that your returns align with your, the values that you endorse, the BMO Balanced ESG ETF is right there, right? These the underlying ETFs, they apply an ESG screener to screen out companies with involved in things like weapons, tobacco, alcohol, gaming, firearms, all that sort of stuff. Your returns, you're probably going to differ a bit, right? Because you're excluding some companies. But once again, the systematic approach that it's constructed with, I have a feeling it's going to minimize tracking error over time. And it's way better than investors trying to apply ESG screenings on their own.
Yeah, just going back to ZMI for a minute, this product is probably the best deal on our shelf in terms of fees as well, because all the MERs on our asset allocation ETFs are 20 basis points. Mm-hmm. But if you look at the underlying holdings of ZMI covered call ETFs, the MERs on those alone are 65 basis points. So you're really, exactly. And there's no double dipping on the underlying fees with our fund-to-fund ETFs. So you're really getting a good deal on some of those higher income or higher cash flow type solutions.
ZMI is a fantastic value proposition. If I went out and bought each one of these income ETFs on their own, I would have, I'm counting, 8 different sources of distributions to manage and keep track of. In a taxable account, that's difficult. Even in a tax advantaged account, like I got to reinvest all of them, I got to rebalance several positions. All right, It's just too much work. But it's managed on your behalf for 20 basis points. I think this is one of the most competitive income products out there. And just on the level of diversification alone, if I wanted income, I would personally hesitate in holding just say a Canadian covered call ETF. But something like this that's globally diversified, has corporate bonds, and heck, even has a little bit of preferred shares in there, I think it's a fantastic product.
Thanks, Tony. All right, Andrew, can you walk us through a more recent innovation on our front where we've brought the T units to the ETF world? Walk us through the new T-Series ETFs here.
Sure, no problem. Yeah, Erin, these have been pretty popular. What we're doing is really bringing that popular mutual fund strategy into an ETF form, and BMO is one of the first to finally do that. With the introduction of these T-unit ETFs, similar to the T6 mutual fund, ZVal.T and ZGrow.T pay both a 6% annual distribution rate monthly. The distributions, the amounts are set at the beginning of the year, so you know exactly how much you're going to get and receive each month. So, for example, if you have $1 million retirement portfolio that would generate $60,000 payout based on the 6%, you divide that by 12, it would equate to $5,000 a month. And those monthly distributions, they'll reset each year to help mitigate the risk of capital erosion while supporting your long-term cash flow needs. So what this looks like in years that your fund increases in value, your distributions, what they'll do is they'll rise for the following year. And whenever on the flip side, if they decrease in value, your distributions will adjust downward in order to reestablish that target payout rate. Series T distributions can offer more tax efficient income as well. They're really a blend of return of capital used on top of the interest and dividends and capital gains earned within the ETF itself. So for example, if your ETF provides a natural distribution of say around 3% within the portfolio, you'll receive an extra 3% of return of capital on top of that to total 6%. That 3% return of capital is your principal, which is not taxed. So this can be a great solution for those retirees who are mindful of how much tax they pay.
Yeah, I think, that's sort of the crowd that we launched these for, is those investors who are moving from that accumulation stage to that decumulation stage, and they can use these portfolios to begin to draw on their capital to fund their retirement, which is a powerful thing. You can also buy it, reinvest the distributions leading up to retirement, and then begin to pay them out as well. So you can stay in the one solution the whole time, which is kind of nice.
Exactly, and it's one of the cool things about ETFs. I mean, you don't have to wait until you're retired to invest in these things. Just having them reinvested, and then when you choose to start taking on those distributions, you can go ahead and do so. So, I mean, furthermore, whenever it comes to the decumulation phase or retirement phase, many retirees are thinking of whether or not their money is going to last, or whether or not they're going to leave a nest egg for their loved ones. And looking into this further, past performance, of course, is not indicative of future performance. However, based on some index charts, if you take a look at it, I was looking at the 2022 version. It's not any different really, because you have a lot of historical background. But since 1950 to about June of 2022, you can see that based on an asset mix of a 60-40 split in favor of equities, although not the same apples to apples comparisons to some of these asset allocation ETFs. The average return is sitting around actually 8% over a 20-year period. In a bullish scenario, that would take you well past that amount that you initially invested. So for a retiree, if they were to pass away at 85 years old, now in theory, using that T6 with that exact type of asset mix, you would end up with about approximately $1.4 million upon death. Now, I use these numbers loosely, but let's just say that a portfolio returned only 4%. A retiree can have that same benefit and be left over with approximately $650,000 over a 20-year period. Most financial planners will take a look over a 30-year period, just in case. So it'll take you around to about age 95 or so, and even then, just to put it in perspective, you'd be left over with over 500K for your loved ones. So these distributions can be used, if used properly, can be very beneficial. Now, these BMO ETF retirement solutions, they include ZBAL.T, ZGROW.T, ZMI, and ZMI.U for those who want to put US dollars to work. And a retiree may not want that 6%. That's fine. They might have enough money where 6% is a little bit too much. And that's great. In fact, one of the frequently used rule of thumb for retirement spending is known as the 4% rule. Although not meant for everyone, what it is that you add up all your investments and withdraw 4% of that total. By following this formula, you should have a very high probability of not outliving your money over a 30-year period. And ZMI and ZMI.U pays out approximately 4.5% at the moment. So you can see here, these retirement ETFs can be an easy all-in-one solution that allows investors to target a specific level of risk based on their investment goals and their income needs.
I also think that as an estate planning tool, asset allocation ETFs can be powerful as well. If I think about inheriting my parents' portfolio that has 50 different stocks, some of which I've never heard about, it gets messy when you're trying to transfer your wealth, whereas asset allocation ETFs can be a nice, simple to understand package to pass on as a nest egg as well. All right, I want to get to a couple audience questions that came in this week. So Tony, if you don't mind covering this one, what is the lowest cost option for asset allocation ETFs?
To the best of my knowledge, it's HGROW, the Horizons Total Return Growth Portfolio. On the face of it, it charges a 17 or 0.17% management expense ratio. Now, the underlying ETFs are subject to some extra trading expense ratios because some of them are swap based. So I'm not quite sure on what the overall cost of the investor is, but as it's stated on their website, is 0.17. Vanguard's VEQT is actually one of the more expensive ones. It's surprising because Vanguard usually has a history of lowering fees, but to my knowledge, VEQT, VGRO, they still come in at 24 basis points or 0.24%. In that respect, the BMO ETFs are very attractively priced, right? They all capped at 0.2 management expense ratio and includes all the underlying fees. So the one mistake I see many people do when they look at these ETFs is that they add up the expense ratios from the underlying ones and they add that on. You don't do that. You're just double counting at that point. The indicated expense ratio on things like ZEQT is what you see. And 20 basis points, if you think about it, sure, you could save by buying some of the individual ETFs, picking the lowest cost, but I'm willing to bet that your brokerage commissions, your bid-ask spreads, and all these other miscellaneous variables will add up over the course of a year to easily rival or exceed 20 basis points. For that nominal fee, there is no better solution than an asset allocation ETF.
Yeah, and just a reminder on fees, always go to the ETF facts sheet to check those out because that's where you'll see that audited MER, that all-in cost. So that's a better place to compare because really, if you're just going on the website and looking at management fee, that's nothing more than marketing really, because you want to know what the MER is. So
you also want to note that. Sorry, you also want to note that the MER is rearwards looking. It's assessed over a period of time. It can change over time, and for many new funds, there is no MER because the fund hasn't been around long enough for all these expenses to add up. So like Erin said, the management fee can be misleading. Always look at the fact sheet. And personally, I like to just look at the prospectus because I think it's important to dive into the ETF beyond just what the fact sheet gives you at a superficial glance.
Good point. Okay, Andrew, I'll give you the next one. Can you walk us through what a tracking error is on an ETF?
Sure. Tracking error is really the difference between a return on an ETF and its benchmark that it follows. There are two ways that you can essentially calculate this, and a very simple way is to subtract the return from one versus the other. So for example, ZSP, the largest US ETF in Canada, it tracks the S&P 500. If that were to return 8%, and the S&P 500 were to return 8.25%, you would have a tracking error of about 0.25%. And another way is using standard deviation from one ETF versus a respective benchmark. If that ETF has a higher standard deviation, you could say that it's not tracking the index very well, so you can do a subtraction there from one versus the other. The truth is, ETFs, they'll have some sort of tracking error, whether we like it or not. And there's many reasons for that associated with it. For example, ETFs do have fees. ETFs will hold a certain amount of cash in them. Maybe they're not getting a proper fill on some securities that they're trying to sell, or there's distributions within the ETF that may cause some cash drag. And if it's not rebalanced right away, it could throw it off a little bit. So there's all these different reasons, such as even bid-ask spreads. If they're paying too much for a particular security within the ETF, that can cause a little bit of fluctuation there. But really, when it comes down to it, it's important to look at these index ETFs and the providers that offer them, and whether or not these ETFs are very large and liquid, and whether or not the companies have the capacity to manage them to achieve these low tracking errors, if that's your goal.
I feel like a bit of a dog with a bone here with the ETF facts sheet, but on the ETF fact sheet, you can actually see the tracking error as well. And the ETF provider will give a bit of a reason for that tracking error too. So if you do see one that's bigger than normal and you want to know why, you can check that out. You know, another reason that I think of, Andrew, is sampling, right? So with things like an emerging markets ETF or a lot of
absolutely
ETFs, portfolio managers specifically with fixed income ETFs, cannot buy all of the bonds in that index. Some of them are even illiquid, and it would just be so costly to do so. So if the ETF is sampling, you hopefully won't see a lot of tracking error, but that could be another reason as well. So that's a great.
I like to also add that tracking error can be positive. It's not just the downside. Occasionally, one thing you might have noticed over the last few years is that non-currency hedged ETFs have dramatically outperformed the benchmarks thanks to a rising US dollar and falling Canadian dollar. Some ETFs may also outperform because their managers engage in securities lending. They're lending the underlying securities of the ETF out in exchange for some interest, and that can occasionally lead to some positive outperformance. Now, positive tracking error is definitely more rare than the usual negative tracking error, just because fees, transaction costs, like Andrew mentioned, add up. But either way, it's in your best interest as an investor to look for ETFs that are able to keep this for minimum and tightly track their benchmarks. And as Andrew said, those tend to be found with more reputable fund managers with a good amount of assets under management, a very good trading team, operations, and administrative team as well.
Well said. Thank you. All right. Well, that wraps up. Thank you, Tony and Andrew, for your great insights. That was a great week of ETF Market Insights. Next week, in honor of Earth Day, which is April 22nd, we wanted to host a session on ESG. And specifically, we're going to be tackling some of the criticisms that ESG investing has been facing more recently, and we'll review the different approaches and also some ways that investors can begin to understand the different options available to them a little bit better. So I'll be joined by Carly from MSCI, as well as Karen from BMO Investor Line, because BMO Investor Line just came out with some really nice tools on ESG, so they'll walk us through those for you as well. So thanks again, guys, for joining me. I hope you guys can join me next week. To our viewers, and bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.